Good day, everyone, and welcome to our August edition of MFP Outcome Matters. I'm Therese Grobler, Head of MFP Wealth Management, and it's absolutely wonderful to have you with us today. With the new financial year now well underway, I think it's appropriate to pause for a moment and reflect. Not on the numbers we've reported or the milestones we've achieved, but on what they represent, the trust our clients place in us, the value of quality advice, and really the collective effort required to help clients achieve better outcomes. The past year has reminded us that the industry is ultimately about people. It's about helping clients navigate uncertainty, make better decisions, and remain focused on their long-term goals, regardless of what markets happen to be doing at any given point in time. And while markets and regulations and technology continue to evolve, some things remain remarkably consistent. One of those is the value of trusted advice. It's interesting that at a time when artificial intelligence and automation and digital tools are receiving so much attention, research continues to highlight that clients place their greatest value on something far more human: trust, guidance, perspective, and partnership. Technology can help us work smarter, and many of you would have already seen examples of this through the recently launched Switch ROA on Advisor Connect and also the portfolio comparison tool on Elite Wealth. But the real value of these enhancements lies in creating more time for what advisors do best: building relationships, having meaningful conversations, and helping clients make confident financial decisions. And that brings us to today's discussion. We'll hear from economists, portfolio managers, investment specialists, and advisors as we explore everything from geopolitical developments and market trends to portfolio positioning, momentum securities, and the enduring value of advice itself. Because while market conditions will change, clients will always need perspective, confidence, and guidance. And that's what great advisors provide. So before we begin, just a few housekeeping points. We have applied for CPD accreditation for today's event. So to ensure your attendance is verified, please watch the full session and submit your ID number under the CPD section. The platform will remain open until the end of September 2026, giving you ample time to revisit the content and earn your CPD points. Certificates will be issued automatically once all the requirements have been met. And as always, please use the Q&A function to post your questions. Our presenters will respond either during or shortly after the session. Today's agenda will achieve two things. It will help you understand the forces that shape markets and also turn those insights into better client outcomes. Sanisha Pakarasamy and Tsiamo Masike will kick us off with how oil fields, algorithms, and ballot boxes are reshaping markets. We then shift from markets to advice with a panel discussion on the advice advantage, with perspectives from our advisors, specialists, and also investment experts. Martin Rickert will share a momentum securities update, and Cole Chitty will be sharing a global and local market update. Then Rupert Gissing follows with an MFP multi-managed portfolio update. Jade Koish unpacks global portfolio returns and its positioning. And then Kusana and Zima rounds out the investment content with a curate update. It's a packed program full of market insights, investment expertise, and also practical advice perspectives, all designed to help you navigate the opportunities as well as the challenges that lie ahead. To help us set the scene, we're starting with a session that examines some of the most significant forces currently shaping the global investment landscape. The title alone sparked my curiosity: how oil fields, algorithms, and ballot boxes are reshaping the markets. Please join me in welcoming Sanisha Pakarasamy, our Chief Economist, and Tsiamo Masike, Economist. Sanisha, Tsiamo, over to you.
Thank you, Therese. Good day, everyone, and thank you for joining us. I am Sanisha Pakarasamy, Group Economist at Momentum Group. At the start of 2026, the global economy appeared to be moving into a more supportive phase. Inflation was easing, interest rate relief was becoming more likely, and economic growth had remained surprisingly resilient. That outlook has become more complicated. Geopolitical conflict has disrupted energy and shipping routes. The artificial intelligence investment boom is creating unprecedented demand for capital, and elections are reinforcing protectionism and policy uncertainty. These developments nevertheless share a common thread. They are increasing the cost of energy, finance, and economic security at a time when governments and businesses are already operating with less room for error. For South Africa, the picture is equally mixed. The economy has shown resilience, and reform progress is visible, particularly in energy and logistics. But the recovery is being slowed by renewed pressure on household budgets, weak investment, municipal fragility, and a more difficult inflation environment. In this discussion, we will unpack the major forces shaping the global outlook before turning to the themes that will determine South Africa's economic path. To help us make sense of these shifts is Tsiamo Masike, economist at Momentum Group. Tsiamo, thank you for joining us today. A lot has happened in the last quarter, but let us begin with the global risk backdrop. While much of the early attention was on the oil price impact of the conflict involving Iran, the economic effects have spread much further. Disruptions to shipping, rising insurance and freight costs, and pressure on fertilizer and industrial inputs are all adding to the costs across global supply chains. And at the same time, geopolitical tensions elsewhere, such as in Russia and Ukraine, have not disappeared. So how should we think about the combined effect of these pressures on global growth and inflation, and what they could mean for the path of interest rates from here?
Thank you for having me, Sanisha. So the conflicts are really weighing on economic growth while at the same time pushing inflation higher. And the IMF forecasts really paint this picture quite well. So if we turn to this chart over here, these are growth estimates and inflation estimates from the IMF. On the left-hand side, you're seeing that with each update, the IMF has actually revised global growth down. So they were expecting global growth to be 3.3% at the start of 2026. Now they're expecting global growth to be 3%. But what you're also seeing is that emerging markets and developing economies are expected to take a bigger knock in terms of economic growth. And this is because they are more exposed to energy markets, plus they are not as well positioned as advanced economies to take advantage of the AI investment boom. When you look to the right, you have the headline inflation estimates. Those have been revised higher from 3.8% at the start of the year, all the way up to 4.7% at the latest update. The good news, though, is that the global economy was not really caught off guard. So when the war started in the Middle East, we had good supply of crude oil inventory, and that did help cushion that initial supply shock. The challenge, though, is that rebuilding those inventories will take time. So when shipping routes reopen, companies and countries will want to rebuild that stock level, and I think that extra demand will keep prices elevated. Also, when you look at refined products like diesel and jet fuel, the prices there will likely remain higher than crude because the stock levels there were lower. If energy prices remain elevated, then households will continue feeling the pressure, but also businesses will have to deal with higher input costs. And this is a combination that leads to weaker growth and much more stickier in inflation. That leaves central banks in a difficult position of balancing weak economic growth and high inflation. What we have observed so far is that most of the global central banks have actually opted to keep rate constants. So of all the global central banks, it's only so far been the European Central Bank and the Bank of Japan that have hiked interest rates. The US and Japan's intervention has pushed the yen stronger, easing the pressure on the Bank of Japan to tighten monetary policy, provided the stronger yen is sustained. But the market is still expecting central banks from the US and the UK to hike interest rates.
I think another key theme playing out in the global economy is this extraordinary scale of investment in artificial intelligence. The largest technology firms are committing vast amounts of capital to data centers, advanced semiconductors, cloud infrastructure, and the energy systems that are needed to support them. In some measures, the spending is approaching or even exceeding the investment intensity of the late 1990s internet boom. But high investment does not necessarily mean that the technology itself lacks economic value. When we look back, the internet ultimately transformed the global economy, even though many early investors overestimated how quickly the financial returns would materialize. So, are we seeing a similar pattern now with AI, where a genuine technological revolution may still be accompanied by excessive valuations and investment running ahead of near-term revenues? Or do you think we are seeing elements of yet another tech bubble?
There are definitely similarities between the current AI investment cycle and the dot-com era, but there are also differences which are quite important. But I think a key lesson from the dot-com era is to say that we can have a technological advancement at the same time having a market bubble. So the two can exist. The signs of a bubble are certainly there. So valuations are high, investment has surged, and also there's a lot of expectations about future returns, and I think that's quite optimistic. One important difference, though, is that the companies that are fueling this AI investment are actually in a better financial position than the companies that were driving the dot-com bubble. So, for example, they are more profitable, the cash flows they're generating are quite strong, but also they have stronger balance sheets. And that is why then they are able to invest into this AI infrastructure. But the challenge is that the scale of investment is now growing at a faster pace than the cash flow that they are generating internally. And you can see that on this chart over here. But also this is why then these companies are increasingly looking beyond their own cash flows to finance the expansion. So when you look at IPO activity, that's increasing. When you look at equity issuance, that's increasing, but also the private credit market is now playing a bigger role in terms of funding this expansion in AI infrastructure. So I do think AI will transform the global economy. The question is whether revenues and earnings grow quickly enough to justify today's valuation. That's what I think investors will be watching for over the next few years.
I think that brings us to the question of, competition for capital globally, and especially at a time when borrowing is no longer cheap.
Yeah.
Governments are issuing a record amount of debt. Corporates are facing large refinancing needs, and the AI build-out requires enormous levels of funding. Can markets absorb all of this borrowing in an orderly fashion?
So I do think markets can absorb this increased funding. It's just that it will come at a much higher cost. So capital is still available, but it will be more expensive. And that's because we're seeing the pressures of funding coming through from all different kinds of sources, all at the same time. Governments are creating the biggest pressure. We can see this chart over here. This is data again from the IMF. It's looking at gross debts as a percentage of GDP, and it has been trending upwards for a couple of years. But also the IMF expects this to continue going up. Global debt levels are already at record high, but also governments are still trying to borrow more so that they can fund the larger fiscal deficits, but also the spending requirements that are coming through from defense spending. This then means that governments and the private sector are competing for the same pool of capital, and therefore this is driving borrowing costs up and can potentially then crowd out private sector investment. Another challenge is that a lot of the debt was issued at a time when interest rates were close to zero. So what's happening is that now as the debt matures, then there is a refinancing need, which then needs to be refinanced at much higher borrowing costs. And this is putting pressure on things like budgets and profits. Ultimately, I think a lot will depend on whether investors trust that governments will have sustainable plans to be able to make sure that they do cap their debt levels from going significantly higher. So governments that have better fiscal positions and more sustainable plans will continue to attract capital. But governments that are losing faith by the market, the confidence is getting weaker there, they will still incur higher borrowing costs. So I don't think the risk is that capital suddenly disappears. It's that it becomes more expensive and investors will then pick and choose who they lend to.
I think a related question here comes to mind, and it's really about how that AI investment boom is being financed. Traditional banks have become far more constrained by regulation and balance sheet requirements. And so we've seen that private credit has now stepped in as an increasingly important source of funding. This has helped to unlock capital at a scale and speed that conventional lenders may probably not have been able to provide. However, much of this lending sits outside of the traditional banking system. So valuations here can be less transparent, loans are less liquid, and risks may be concentrated amongst the interconnected lenders and the investors. So if the expectations around AI revenues or asset values prove to be too optimistic, could the private credit channel become the one in which stress then spreads more widely across the financial system?
That's certainly an area that does deserve close attention. But when we look at the data, it's not suggesting that the private credit market is a point of significant financial systemic risk at the moment. Yes, the market has grown quite significantly. It has quadrupled since 2010, but the quality of those loans remains relatively well, and the bad debts are also still quite low. However, the concern is less about the loans themselves and more about how that market has now become connected to the traditional financial system. So when you look at this chart over here, it's showing how banks are now lending more and more to non-depository financial institutions than they were a decade ago. And I think this is a clear transmission channel of how stress in the private sector market, private credit market, can then transfer to the traditional banking sector. You mentioned transparency and liquidity. Transparency is indeed an issue because these loans and this credit is done on non-public platforms. So it does then become difficult for investors to assess the value of these loans, but also to see where risks are now starting to emerge. So this can become a problem if then stress does emerge in the private credit market. Liquidity is also a concern because the nature of these loans is that they are long term. So if investors want their money, it may be difficult to sell quickly and get that money quickly, again, adding to stress that could potentially then come through. The good news is that we're not seeing those stresses today. So banks remain well capitalized. So I think the private credit market should be seen as a vulnerability rather than a crisis at the moment.
So we've discussed a lot about capital and AI, but I think let us now turn to politics. US voters remain concerned about prices and the economy. President Donald Trump's approval rating has weakened, and the president's party has historically always lost ground in the midterm elections. Meanwhile, the announcement of new tariffs has reinforced protectionist policies despite the courts challenging some of the earlier tariff measures. What do you think the midterms could spell out for economic policy, global trade, and just financial markets in general?
The upcoming midterm elections will be very important because they will determine how much of President Donald Trump's policy agenda can be implemented over the next 2 years. He does enter this race in the midterms at a much back footing than he did previously. When you look at his approval ratings on this chart over here, it shows that it has fallen from just below 52% all the way down to 39%. And this is when the cost of living crisis is weighing on consumers and it's starting to show in these numbers. Another important factor going into the midterm elections is the growing share of independent voters. So independent voters did help President Trump win the election in 2024. So they could then once again be the deciding vote on who controls the House and who controls the Senate. So what could the midterms mean for economic policy, markets, and global trade? I think it all depends on the results of the elections. And there are 3 scenarios that I want us to go through. The first one is if Republicans retain control of the House and the Senate, we are likely to see more tariffs, continued support for domestic manufacturing, further deregulation, and expansionary fiscal policy. That could lead to larger budget deficits, higher government borrowing, upward pressure on bond yields, and a weaker US dollar over time. If Congress becomes divided, then it means it may be more difficult to have legislation passed. And in this type of environment, we could have more policy certainty and less surprises for the financial market. If Democrats take control of Congress, we could see some trade measures being softened. You can have greater support for clean energy and closer cooperation with international partners. Even then, though, I think major policy changes would likely happen gradually because President Trump would still be in office.
Turning to South Africa, the disruption to Middle Eastern shipping routes initially raised serious concerns about fuel availability, given our dependence on imported crude oil and refined petroleum products. Yet, the country managed to avoid the widespread shortages and severe supply interruptions that many had feared. At the same time, avoiding an immediate shortage does not mean the economy was unaffected, as longer journeys, higher freight and insurance costs, and increased fuel prices still filtered through to businesses and households. What do you think this episode has revealed about the remaining vulnerabilities of our energy and logistics systems?
So one of the biggest takeaways from the Middle East conflict, it just showed how resilient South Africa was, and I think many people didn't expect this. But it also did reveal our vulnerabilities. So part of the reason why we managed to then avoid that major fuel shortage is that we did quickly diversify where we import our fuel from. So when you look at this chart over here, it's showing you just between March and April, we started importing more fuel from Europe and the United States, which then meant we did decrease our reliance on the Middle East. However, because we are still exposed to international prices, we are still getting that impact from higher crude oil prices filtering through locally to higher fuel prices and higher transportation prices. But also, we had the recent suspension of diesel exports in Russia, and that also has added pressure on diesel prices. But this also shows that we are still quite exposed to shocks that are happening in the global system. One of the biggest vulnerabilities that came through from this is South Africa's very low strategic crude oil reserves. The conflict also highlighted a missed economic opportunity because what we saw is that we had more ships now passing through the Cape of Good Hope, and they weren't really docking at our ports. They were passing, meaning that we haven't really taken advantage of our geographic location. And this is something we also witnessed in 2023.
South Africa's ability to manage the immediate fuel supply points to a degree of resilience and should be commended. But that resilience is not yet translated into a more convincing macroeconomic recovery. We know that households remain under pressure from elevated living costs, fixed investment remains subdued, while constraints in electricity, logistics, and municipal service delivery continue to weigh negatively on economic activity. Are reforms in the areas such as energy, freight logistics, and infrastructure beginning now to build a stronger foundation for the medium-term growth outlook? And what do you think still needs to change for that progress to really become more visible?
So reforms are building a stronger foundation for medium-term growth. Unfortunately, though, when we look at the business leadership of South Africa's tracker, it does show that there was a slowing in reform momentum. So when you look at the chart on the left-hand side, you're seeing that it did turn negative in the second quarter of this year. And this was the first time it turned negative since 2 years ago when the reform tracker was established. And this is because on the right-hand side, economic reforms did slow quite significantly. But that doesn't mean reforms have stopped. We have seen progress and there have been positive updates. For example, Eskom's operational performance has improved significantly. You've had load shedding, which has largely been avoided. Rail reform continues to move forward. And we've had further private sector participation in both the electricity and logistics sectors. Now, these are all positive steps. It's just that we are still experiencing delays in some areas. For example, the National Rail Bill has still not been tabled. Electricity market reforms have slowed, and municipal debt to Eskom continues to grow. So while the policy direction is positive, I think implementation is one of the key areas that we need to focus on to ensure continued progress.
I think especially at a time when South Africa's local government elections are approaching, coming up in November this year, and at a time when municipal finances and service delivery are really under severe strain. The contest also carries significant national political consequences. So what do the current polling and by-election trends suggest about the risks facing the largest political party in South Africa, the African National Congress, and then just the broader direction of national politics?
So the latest national polling data that we have from the Social Research Foundation, which you can see on this chart over here, does show that the ANC will likely to continue to lose support in the local government election. But also a key insight from this chart is showing that no one party is likely to remain a dominant party. And therefore, this means that coalition politics will likely remain a feature in our political landscape, particularly at these large metros. So the most closely contested metro will likely be Johannesburg, which contributes about 18% to South Africa's GDP. And again, the polling data there suggests that the DA may emerge as the largest party, but it may then not be the outright ruling party in the metro. For the ANC, a weaker than expected performance could put pressure in terms of internal leadership, particularly at a time when you have pala issues, which are creating a lot of concerns. And those issues together then will have an impact on how the ANC performs in the 2029 national elections. So I think the local government elections will likely reinforce South Africa's shift towards an era of coalition politics. But for investors will want to know the coalitions that are being formed. Will they come about with better service delivery, better governance in these local elections? And will this then result in better investment, which will boost economic growth in South Africa?
Let's maybe change gears to inflation developments in South Africa. You gave us your thoughts on the global front. And I mean, inflation was one of South Africa's strongest macroeconomic tailwinds at the start of the year. And now there are signs that energy, food, and weather risks could converge. So how serious do you think that threat is? And what does this mean for actions from our central bank?
So the biggest change to our inflation outlook this year has really been that Middle East conflict and the impact it had on crude oil prices, which then filtered through to South Africa's inflation rate. You can see from this chart over here that transport, which is in red, did increase quite significantly, and we also saw inflation rising all the way up to 5% in the June number. The key concern is whether the energy shock will then coincide with weather-related shocks, particularly for food inflation. Currently, food inflation remains contained, but we have the El Nino now, which is more dry weather conditions, and that is a risk to the food inflation outlook. But we see that as more risk for the end of 2026 towards 2027. But also how far the Middle East conflict evolves will also then be a key determinant for food inflation, because where fertilizer prices end up, particularly towards the end of the year when we start our planting season, will then determine how food inflation then develops. So from a monetary policy perspective, I think the Central Bank of South Africa will assess whether or not the risks coming through from the Middle East are temporary or they become persistent. So in terms of raising inflation expectations, but also wage growth expectations. And they will also then look out to see how the food inflation risks do then transpire. The SARS July scenario do highlight these risks. So there they had oil prices going all the way up to an average of $100 per barrel in 2026. And inflation expectations becoming de-anchored. And if that happens, then we can expect further interest rate hikes this year. But again, the situation does remain fluid, and we could see fuel prices coming down, and that means then we can also see inflation expectations coming lower. And according to their scenarios, in that type of environment, they could start cutting rates towards the end of this year.
For home loan owners, let's hope it's the latter. Now, I think a lot of what we spoke about today spells out a global risk-averse environment. And strangely enough, the rand has actually been more resilient than many have expected. And even the sovereign rating story has also become somewhat more constructive. What do you think is actually supporting the local currency, and can that resilience last?
The rand has definitely been surprising to the upside this year, and it has performed better than other emerging markets against the United States dollar. There are a few things that are supporting it. So the terms of trade has been supporting it. When you look at this chart, terms of trade has been elevated, although we have had that pullback because commodity prices have come through. But secondly, there has been gradual improvement in the domestic story. So we had inflation targets coming down to 3%. The fiscal story is improving, but also you had sovereign credit rating upgrades that came through that did also then help support the rand. However, the rand is an emerging market currency, meaning that we are not insulated from global risks that do come through. So for example, if the United States increase interest rates, that would be negative for the rand, but also if we have that global risk-off environment. So I think resilience can continue, but we are not insulated from what happens globally.
Thank you, Tsiamo, for those insights. To sum it up, I think we can see a clear thread running through today's discussion, and that is energy security, AI infrastructure, sovereign borrowing, and geopolitical resilience are increasingly competing for scarce capital. The global economy remains resilient, but conflict, persistent inflation, refinancing pressures, and protectionism are testing that resilience. AI could raise productivity, but it could also concentrate risks in capital markets. Meanwhile, South Africa has avoided fuel shortages, maintained fiscal discipline, and made progress in energy and logistics. However, household pressure, municipal weakness, and renewed oil and weather shocks could constrain growth and keep interest rates higher for longer. Thank you, Tsiamo, for shedding light on these market-moving economic developments.
Thank you, Sanisha.
Thank you for being with us today. Until next time.
Thank you, Sanisha and Tsiamo. So we've heard a lot about the forces shaping markets, but clients don't experience markets. They experience life. They worry about retirement, their families, their businesses, and most importantly, their futures. And that's where advice makes all the difference. I'm absolutely delighted to be joined by our panelists as we explore the advice advantage. Joining me today are Marinda Lutig, MFP Wealth Management Specialist. Next to her is Cole Chetty, he's the Head of Investment Proposition at Equilibrium. And then two of our senior advisors, JJ van Wyk, and on my right, Aubrey Bielefeld. So let me start with a simple question. If every advisor has access to the same set of investment solutions, why would a client select to go with you, JJ?
Therese, thank you. Yes, I think it is this question is a very, very important question that every financial advisor need to be honest to themselves and answer for themselves. I think clients want to be heard. They want to know that the financial advisor has got their best interests at heart. Mm-hmm. And our biggest responsibility is to guide our clients to the right point in their lives by our advice and supporting them.
Aubrey, do you feel the same?
Yes, I agree completely with that. What I would add to that is that clients need to make informed decisions, because from informed decisions, confidence is gained. And as soon as people have confidence in their decisions, people are prepared to stay the course within that process that you've aligned and put in place for them.
So it's interesting, what I hear from both of you has got nothing to do with fund performance, although surely that's a component of the advice process. But it's quite interesting that both of you alluded to behaviors in clients and habits and how important it is to help guide clients through certain behaviors. JJ, I'll start with you. Can you give me some guidance on how advice has changed over the past 10 years to speak more towards behavior, perhaps, than just pure fund performance?
Yeah, I was thinking, I've been now in the industry 33 years. When I started, I think we had 5 funds: an equity fund, a variable fund, a managed fund, a balanced fund, and a property fund. And you couldn't even tier that funds. If you had to pay somebody income, you had to choose the fund that you've chosen because you only had one fund. Now, today there's thousands of funds. It's impossible for us to be portfolio managers and choose the right fund. Our responsibility towards our clients are totally different. Now, coming back to the momentum and what we stand for, we build and protect our clients' financial dreams. And it's not financial goals. For me, you need to sit with your client and you need to guide yourself with them to achieve that financial dreams. And we don't have the time or the capacity to choose funds. We need, our expertise lies in tax-efficient investments, time horizon investments that aligns with what the client wants for themselves. Is it a short, medium, or long-term investment? And that is where our expertise lies, is to work with our clients to attain their financial goals and dreams, most importantly.
So I think it's very important that we always focus on the purpose, and the purpose is to build and protect our clients' financial dreams. And most certainly, MFP have set ourselves up to make sure that all our support structures are, our DFM partners, our compliance teams, all make sure that we can support you and your practice in those discussions. Marinda, I would like you to weigh in, please. So advice is such an important component, and our advisors often spend quite a lot of time making sure that compliance is in order. We know that that's quite cumbersome, that fund performance conversations take place. But how do we as MFP Wealth Management support that advice proposition from a team perspective to make sure that they do have the time to sit and build and protect their clients' financial dreams?
Thank you, Therese. So I think the MFP Wealth Management value proposition is not about only providing investment solutions to the clients. It provides a framework that is based on the client's objective, the time horizon, and the risk. It's set up in a way that the advisor can easily navigate those decisions, the recommendations with the client, and the client can understand why he is invested in a certain solution. It takes the risk of the advisor in terms of performance, but it shifts the advisor to a framework that guides him in terms of the correct recommendations, and he's able to defend and justify why he's going into a certain solution.
So we manage that framework quite well. Aubrey, I know that you are well aware, and it includes our multi-manager solutions, it includes fund of funds, it includes our single managed funds, and then it also includes momentum securities, annuities, structured solutions. So that framework is quite robust, and we make sure that we manage it very well. Aubrey, when you approach a client's portfolio, how do you make sure that from that entire framework, that's due diligence, that there's enough flexibility to make sure that the outcome you're solving for the client also aligns with the performance expectation?
Yeah, I think the important part there is to understand the client's needs properly. And, once you're able to sit down and spend time with the client and understand their needs, and very often they don't understand their own needs. So it's a discussion that takes time to sit down and explaining to people, where timelines come into play, risk with regards to the different timelines. That puts us in a position where we are able to guide the clients into the correct structure, taking tax into consideration, as you've mentioned, and then making sure that they are positioned best for the outcome that they need. And then with the solutions that we have in place and the people that we are able to spend time with and communicate with, we are also able to get the clients through the difficult times. Because when it's going well with investments, the discussions are simple with clients. Clients say, where do I need to be? Well, you need to be there. Am I there? No, you're actually ahead of that place at the moment. So those discussions are actually very simple. The complicated discussions come when it's not going well.
Yeah.
And depending on where they are in their life, pre or post-retirement, those discussions become, much more complicated, because they need to understand that there's a structure in place, but there's also a plan within the structure to accommodate these different timelines that you're going through. And you stick the course, and it will give us by far the best opportunity to still stay on track after the times have passed, because inevitably they do.
It just speaks back to that behavioral component. You know, the industry-wide tendency is always to be thematic, and we've heard so much about behavioral finance, but I think you've explained it so well to say that the basis for keeping a client invested is that coaching aspect.
And maybe I can add there before you go to the next question. We're talking about the value of advice here, right? And one can actually now quantify what the value of managing client behavior is. And we can actually put a number to it. So one example is within Momentum Investments, we conduct a lot of research on the Momentum Wealth platform using the data that we get from there. And we can actually analyze the decisions clients are making and the impact of some of those decisions. And we do an annual report on some of those insights. The latest one in 2025 showed that clients that switched very frequently, it cost them up to 2 to 2.5% in returns last year. That was for the whole year. And during times when markets are extremely volatile, like we had the tariffs situation last year, like during those specific times, the cost of switching into different funds can go as high as 4 to 5%. So we mustn't underestimate the value of helping clients manage their behavior correctly.
I think it's such a good point to make, Cole, because what I've seen often in conversations with clients and advisors, when we focus purely on the fund performance, you tend not to take those things into account, the cost of switching. And that really is detrimental. We've spent a lot of time, Miranda and the rest of the team, talking about RRs, because that's the proof in the pudding. Incidentally, I don't know if everyone is aware of it. In 2025, we also did a lot of research with the Bureau of Market Research. And on aggregates, households who partnered with a trusted financial advisor, their portfolios were on average 9.5 times the size of those that decided to go it alone. And it speaks back to those components, Cole, where it's not about asset management, fund management. We've got professionals 24/7 doing that. It is about spending time in front of your clients. I would like to ask you, Aubrey, if I look at your book, it's quite a consistent book. Your book is growing at a steady pace because you've aligned with certain strategies and the expected growth in your own practice. You can then plan on growing at that same pace. Have you found it's very difficult to talk clients off ledge when they want to switch to some external managers, some well-known managers, just because it's that sense of comfort? It's quite difficult to talk them off that ledge, keep them invested.
It is. I've also found you must be cautious of overdoing that discussion. People very often have personal experience in life, and because of that personal experience, they've got a perspective on certain things. So when you find clients in a position like that, you need to spend time with them and first change the perspective before you change the decision at the end of the day. And that takes time. So, there will be times where I will speak to clients and they'll have a very specific request. And I will not always try and change that request from the beginning, as long as that request falls within the framework that I'm comfortable with within the advice process. I won't try and speak them off that ledge. But once you've got the client and the client trusts you and understands the processes, you can always go back to that decision and revisit it, and then over time, change that. Now, obviously, tax comes into play depending on the structures and all these type of things. So you need to make sure that you take those things into consideration when having those discussions. But inevitably new money flows and it gives opportunities for new decisions to be made.
That's good advice. Carl, I want to take it back to you. We've got a very specific framework and as MFP Wealth Management, quite a set approach to investments. That said, the underlying funds in each of our solutions are quite flexible. Am I right?
Well, we use a building block approach
Yeah.
in the way we construct portfolios. So the way we start off is in determining what is the optimal asset allocation for the goal or the outcome that we are solving for. And remember, when we talk about outcomes, it's not just about return. Return is only one dimension of the outcome. The way we define an outcome is, yes, return. Time horizon is very important, like JJ mentioned earlier. And then also the risk that the client is willing to take is also part of the outcome. So those three things define the outcome. And the first step to solve for that overarching outcome is by determining what is the optimal asset allocation for that outcome. That by far explains 90% of the risk and return of a portfolio. So spend a lot of time getting that right. And even before we get to selecting the fund managers, some of the work we do before that is to determine within each asset class, what are the sort of, we call them risk premia, that is driving that asset class over time. So within equities, it would be things like value, growth, momentum, quality that actually are far more important in explaining performance than the fund manager itself. And the last step of the process is actually within each of these buckets, now finding the best fund manager to execute on all the work we've done before. So I don't know if that answers your question directly, but that's how we construct portfolios.
Well, it certainly gives me comfort that we're not married to a manager. We are married to a process. Well due diligenced, making sure that the asset managers deliver on their mandates and so forth. And I think it's also comforting to know that those things are flexible. If we find a manager doesn't work, then we can make those changes. And we've got on top of that the institutional pricing and the fee dispensation at platform. Okay. Miranda, do you believe our approach to fund selection, building portfolios, and how we support the advisors, do you believe it's flexible enough so that as and when clients change in terms of advice and the requirements, is it flexible enough to absorb and cater for those changes?
I fully agree. Thanks, Therese. That's also the benefit of being backed by a big brand like Momentum. We've got the teams, we've got the resources to enable us to stay ahead of what we need to stay ahead of, and to change as the times and advise change. So yes, I agree.
It's comforting to know that two of our most senior advisors agree and that you guys feel supported. I think the biggest question is, how do you see advice changing in the next 10 years? So while we can provide you with research and all of that, what in your mind you need to cater for? How do you think that industry is going to change? Aubrey, I'll start with you.
Yes, that's why they call it the unknown. I think the important part is to understand that things will change. And because of that, you need to stay in tune with the changing and the time. Spend time with people in compliance. Compliance drives a lot of these changes for us. We are in a position where we are able to interact with our compliance departments and spend time with them. Compliance drives good behaviors at the end of the day.
Yeah.
It's a cumbersome thing at times, and sometimes it feels as if it wastes certain time, but in the process, it's a very positive way. So I think if you stick as close to the compliance process as possible, you end up being ahead of the curve with all the changes that are on the way, which makes it, a lot easier. And then just with regards to the funds and the compliance and all these things, the more time and research is spent into these things, preparation leads to confidence, and confidence adds ability at the end of the day.
Absolutely. Trust your partners. JJ, would you like to add anything?
Yeah, I think there is advice has come a long way. Yeah. If you take away it was 30 years back, versus today, I don't think the changes is going to be that much in the next 10 years. I think our role as financial advisors at this stage has been defined as the person who's going to sit with the client and do a holistic review of where they are now and what they need to do now to get what they need later. So we're going to be basically the hand that is going to hold them through the process.
Yeah, I agree.
And that is very important, that we as financial advisors do understand that we've got the responsibility to put our clients first.
And I just add one point to that. I think the next 10 years is going to be defined a lot by the advent of artificial intelligence, right? And it's going to accelerate quite a bit in the next 10 years. And I think one of the impacts of that is access to information, investment information, access to product information. It's going to be very easy for clients to get access to all of this. But the one thing that's going to remain, I think, it's going to remain scarce over the next 10 years is trust. And that's where I see the advisor playing a very meaningful role, especially with heightened market volatility that we're seeing in this age of geopolitical uncertainty. So understanding clients' needs, applying judgment to their personal circumstances, making personalized recommendations, and providing advice that meets their context.
Marina?
Yes, I want to add, I think the clients won't value advisors for products and market views, because that's technology and AI already provides that. But I think the advisor of the future will combine AI or technology and the human factor. So they will use AI to advance or enhance the advice, but they still need to provide context, which the AI or technology can't provide.
I agree. You know, the more we look at advancements in technology and AI, the more the human factor remains an issue. In fact, I've had a client say to one of our advisors that they've done, I'm not sure which system they used, but I would assume it's ChatGPT or Claude or one of the big ones. They spent a huge amount of time analyzing a financial plan, did all the calculations. And after all of that, they had one question. So what do I actually do? And I think that's the most pertinent question. So I'd like to thank everyone for your time today. Thank you for sharing your experiences. Thank you that we could leverage a little bit off the school fees that you may have paid. And I look forward to partnering with you in the future and see how we can support you as advice changes. Thank you to our panelists for sharing your experiences and perspectives. We now shift our focus back to the markets and the opportunities they represent. To guide us through the latest Momentum Securities developments, please welcome Martin Rickert, the brand new CEO of Momentum Securities. Martin, over to you.
Thank you, Therese, and good day, Team MFP. It's always great to engage with you as partners, and these regular Outcome Matters events are becoming a regular ritual where we can take stock of the investment markets, consider the solutions we have available to our joint clients, and also assess how these fit into your advice process. So today, I will focus on Momentum Securities as a partner to MFP, and how we offer your clients a range of listed market instruments that can assist them on their investment journey to success. So although the main focus of today is to talk about how these instruments can fit into your advice process, I will start off by briefly covering what we as Momentum Securities can offer you and your advice practice. I will also indicate where you can access these, and then the rest of the session will focus on your advice process. But let's immediately start with Momentum Securities and what we offer to you and your clients. In essence, we offer two major services. The first one on the left includes the typical activities of a stockbroker, which is of course providing efficient and seamless access to the listed markets. These include access to listed shares, ETFs, derivatives, bonds, and structured products. Therefore, any instrument that is typically listed on the JSE. We also offer similar capabilities for offshore markets, but more about this a little bit later. So on the right-hand side, however, is where we believe the true value of Momentum Securities come together. And this is the share portfolio management services that we offer. So many providers in South Africa provide the left-hand side, but Janine van Heerden always states that our true value proposition is where our portfolio managers on the right work directly with your practice to build portfolio management solutions that can truly suit your practice and adapt to the needs of your clients. So these range from discretionary solutions that typically is most suitable for smaller to medium clients, or to the very bespoke solutions that can be customized to suit the very demanding needs of your high net worth clients. So the range of services we offer is summarized on this slide, but I want to highlight two specific aspects that will be most relevant to your advice practice. The first is that our offering includes tax-free savings accounts, and this solution therefore provides a tax-efficient growth vehicle for your clients. And the other aspect I want to highlight is securities-based lending. This facility provides your clients who have share portfolios some liquidity without the selling of their shareholdings, and therefore avoid the materializing of any capital gains. So we recently launched this facility on Wealth's personal share portfolios, or PSPs. As I mentioned earlier, we offer all of these services on any JSE listed instrument. But in a world where we realize that offshore exposure is becoming increasingly more relevant for your client base, we also offer these capabilities on the broader offshore listed markets as well. And we do this in partnership with Swissquote. As the name suggests, Swissquote is an offshore technology provider that is domiciled in Switzerland. Their capabilities are truly world-class, and they are continuously investing in their technology, and their offerings are expanding continuously. It therefore provides access to thousands of offshore investment opportunities, and in addition to this, can provide your clients with a multi-currency card that they can utilize for offshore purchases or travel expenses. Just some of the benefits that your clients can experience due to our partnership with Swissquote. Now that you know about these range of services that Momentum Securities offer, the next question is, where can you access these capabilities? There are essentially 3 access points for you as MFP advisor. You can always access these services directly with a Momentum Securities account, or you can access these via PSPs or personal share portfolios on Momentum Wealth and Momentum Wealth International. This flexibility is important, as you as advisor can therefore take your clients' estate planning requirements and tax status into account when structuring any share portfolio or structured products. Just another example where Momentum Investments ensure that we fit into your advice process. Now, talking about the advice process, let's move on to how share portfolios can potentially fit into your process. And let's start by focusing on your role in this process. So at Momentum Securities, we are quite clear on what your valuable role as financial advisor should be. We don't believe that there should be stock picking or even portfolio management. You should rather partner here with professionals who do this for a living. We believe that your value in this process is no doubt by providing holistic advice to your clients, which naturally takes your clients' tax, liquidity, and estate planning requirements into account. And when your advice process has identified that your client's financial plan can benefit from a share portfolio or a structured product, then you can phone a friend where a Momentum Securities portfolio manager can then seamlessly step in. All our portfolio managers are phase licensed, and they can therefore complement your process by providing advice and related services. So during this whole process, you will remain the main and primary contact for your client, and our portfolio managers therefore collaborate with you to service your client. A true partnership in practice. So the next question is, when will share portfolios be relevant to your clients? We have to acknowledge that share portfolios won't be for everyone. And the reason for this mostly revolves around risk tolerance and risk capacity. So some of your clients' financial circumstances might simply be too tight for them to take on additional risk, typically something that is associated with share portfolios. Now contrast this with highly affluent or high net worth individuals and sophisticated investors who most likely have sufficient surplus assets to justify that they can afford some additional risk. This is no doubt also coupled with the requirement that clients must have a long-term investment horizon, as share portfolios can introduce material volatility in the short to medium term. I should also mention that some of these growth-geared portfolios can also be combined with some risk protection mechanism to provide some downside protection, typically the arena of structured products. Now let's contrast this with conversation by listing which clients are highly unlikely to be considered for a share portfolio. Properly managed share portfolios are definitely not a performance-chasing mechanism. The main purpose is still long-term growth and therefore not short-term performance. Now, given the earlier discussion around risk capacity, it also is unlikely that a client with small investment portfolios should be considered for share portfolios. And an overarching principle is that you as advisor needs to ensure that clients have a clear understanding of the risks involved when investing in share portfolios or similar assets. Now, taking all of the above into account, how can you practically then incorporate the share portfolio into your advice process? It is clear from the earlier conversation that the first step is to identify which clients are suitable to investments in share portfolios. The second step is then to decide which capital should be allocated to share portfolios. Now, we believe that most, if not all, clients should first have a foundational allocation of their capital to core MFP wealth management solutions. The reason for this is that even for affluent or high net worth clients, a core part of their capital should be earmarked for some specific future need, whether this is for education provision, retirement provision, or some other financial goal. And in your advice process, these provisions will be linked to some MFP solution, most likely one of the solutions that are managed by Equilibrium. Now, these solutions were designed and are actively managed to align to your advice process. Now, after you covered the core part of your client's financial plan, then you can reassess whether there are any excess capital, now or in future, which can then be allocated to asset classes that aims for higher long-term growth. And if this is available and your client's risk capacity allows for it, then you can allocate these to share portfolios, either locally or abroad. A Momentum Securities portfolio manager will then be ready to support you through the process and portfolio selection, as well as the ongoing management process. So, in summary, now you know that you have access to a wide range of listed instruments, both locally and abroad, via Momentum Securities. Although this world can be complex and overwhelming to your clients, we believe that your role remains to provide holistic financial advice. You know your clients and their circumstances best, and you can therefore take these aspects into account, while you can also identify which of your clients might benefit from a share portfolio or a structured product. Now, it is at this stage when Momentum Securities and our portfolio managers can become involved to complement your advice process by recommending and managing of an appropriate portfolio of listed shares or other instruments. Contact your MFP Wealth Specialist for any more information. I want to again thank MFP and each advisor for our long-standing partnership with Momentum Investments and Momentum Securities. It is very rewarding to hear how we work together to build and protect our clients' financial dreams.
Thank you, Martin. We've heard about individual opportunities. Now, let's step back and look at the broader investment landscape. Please welcome Carl Chetty. He is the head of investment proposition at Equilibrium, and he will provide the global and the local market update. Carl, please go ahead.
Thank you, Therese. Hi, everyone. It's my great pleasure to now provide you with a comprehensive overview of what's been driving global and local financial markets in the second quarter of 2026. But before we dive into the quarter itself, I think it's worth pausing to reflect on how economic conditions have evolved thus far in 2026. And the chart here is from one of our underlying fund managers, Fairtree Asset Management. It shows the performance of three key economic indicators over the last few years: short-term bond yields in the US, the US dollar, and crude oil prices. And as can be seen, economic conditions eased in 2025, with short-term bond yields falling, the dollar weakening against most currencies, and oil prices falling to as low as $60 per barrel at the end of the year. And this created quite a favorable environment for companies and consumers. But economic conditions have tightened since the onset of the US-Iran war on the 28th of Feb 2026. We have seen bond yields rise on the back of inflation concerns, the dollar strengthening due to its perceived relative safety, and oil prices remaining materially higher than they were at the start of the year. But despite these tighter conditions, equity markets around the world have generally continued to steam ahead this quarter, and we'll explore the reasons why. So there were 4 key events and themes that impacted global markets in the second quarter. The first was the US-Iran war roller coaster. The war broke out on the 28th of February and continued to escalate through March, April, and May, disrupting energy markets, pushing oil prices sharply higher, and raising concerns about global inflation and growth, triggering a warning from the IMF that higher commodity prices, inflation risks, and tighter financial conditions could weigh on the global economy and particularly hurt energy importing emerging markets. However, sentiment improved markedly towards the end of the quarter as a US-Iran agreement on the 17th of June and subsequent ceasefire efforts reduced the risk of a wider regional conflict and helped to reopen trade routes through the Strait of Hormuz. Oil prices quickly retraced much of their war-related surge, temporarily removing a major inflationary risk and supporting risk assets globally. The second key theme, and perhaps the strongest one for the quarter, was a renewed surge in enthusiasm around AI infrastructure. Investors focused on massive capital spending by hyperscalers and AI companies on data centers, semiconductors, memory chips, and related infrastructure. Semiconductor shares led global markets, and AI-linked equities experienced some of the strongest quarterly gains on record. The narrative shifted over the quarter from concern about these massive AI spending levels to optimism that AI-related demand would continue driving earnings growth for companies involved in the AI infrastructure build-out. As a result, the tech and communication services sectors became the primary engines of global equity market performance in the second quarter. The third key market-moving theme was strong earnings releases, particularly in the US. Entering the second quarter, investors were worried that the Middle East conflict, elevated oil prices, and tighter monetary policy could damage corporate profitability, but instead, many companies reported stronger than expected Q1 results during April and May, demonstrating that demand, margins, and business investment actually remained quite healthy. This gave investors confidence that the economy was slowing but not falling into recession. Initially, much of the stock market rally was concentrated in large tech companies, but as the quarter progressed, earnings strength broadened across sectors and across market caps. As earnings beat expectations, market participants became more willing to pay higher valuation multiples, particularly for growth stocks. The result was a powerful re-rating of equity markets, especially in the US. What was also notable is how quickly investors looked beyond the geopolitical headlines. Even while concerns around Iran, oil prices, tariffs, inflation, and future Fed policy persisted, equity markets increasingly focused on company fundamentals. The logic was simple. If earnings continued growing at a healthy pace, many of these macro risks could be absorbed by corporate profit growth. A fourth key theme to take note of in the quarter was related to monetary policy and interest rate expectations. In the US, a change in Federal Reserve leadership occurred when Kevin Warsh succeeded Jerome Powell in May. Markets closely watched the transition and the implications for future policy. And although investors initially anticipated easier monetary policy later in 2026, stronger economic data and persistent inflation resulted in a more hawkish tone from the Fed by June. But despite the hawkish shift, equity markets generally interpreted economic resilience positively and continued moving higher. But those weren't the only interesting developments in the quarter. After several quiet years, the global IPO market is showing strong signs of recovery in 2026. The chart here is from Ned Group Investments, and it shows the average proceeds from IPOs for the current year to 31st of May and for each of the last 10 calendar years. And thus far this year, deal sizes have already reached record levels, with the average IPO valuation being 3 times the size of last year's average and nearly 10 times the size of the 2022 average. The resurgence is being driven primarily by AI-related companies and the infrastructure supporting the AI ecosystem, resulting in a pipeline of larger listings such as SpaceX in June and Anthropic, which is targeted for October. The question is whether these valuations are justified or whether the founders of these firms are just taking advantage of the current investor exuberance towards AI. Time will tell. Let's now move from the economic backdrop to actual investment performance. The chart on this slide shows the cumulative performance of the 4 major global asset classes we look at for the 1-year period to the end of June 2026, all measured in US dollars. The dashed black vertical line on the right marks the start of the second quarter, and the returns for the full quarter are shown in the black block on the top left of the chart. And looking across the major global asset classes, equities, as measured by the MSCI All Country World Index, once again emerged as the strongest performer, with an impressive return of 15% over the quarter and 24% for the full year. After falling steeply during the onset of the war in March, equities staged a very strong recovery over April, May, and June, actually the strongest quarter for global equities since 2020. The recovery was firstly powered by resilient corporate earnings, with first quarter earnings for the MSCI ACWI up a sizable 24% on the prior year. Secondly, the AI-driven CapEx cycle continued to be a primary driver of equity growth globally, although it was concentrated in a smaller set of AI-linked megacaps in this quarter. And then lastly, there was also a meaningful relief rally in the middle of June after the US and Iran signed an MOU that ensured the naval blockade in the Strait of Hormuz was lifted. Global property also delivered solid results, with a return of close to 10% in the quarter and 13.5% over the full year, benefiting from resilient operating fundamentals, constrained new supply, and growing corporate activity as private capital increasingly recognizes the value on offer in listed property markets. Data centers in particular have been a key growth area, with demand significantly outpacing supply as AI capex has exploded. Global bonds generated marginally positive returns in the quarter and was essentially flat over the 1-year period, as investors continue to navigate this complex balance between inflation expectations, interest rate policy, growth prospects, and massive fiscal spending levels. In the quarter, the resilience of global economic data releases helped central banks to pivot in a more hawkish direction. And that was particularly clear in the US, where the 3 jobs reports released during the second quarter actually all surprised on the upside. Furthermore, the first Fed meeting chaired by the new governor, Kevin Warsh, was more hawkish than expected, leading markets to price in higher rates by the end of 2026. Meanwhile, cash provided stability and liquidity, but lagged growth assets with a return of 1% in the quarter and 4% over the full year. And this slide reinforces one of the most important principles in investing. The highest long-term returns typically come from assets that will experience short-term volatility. Investors who attempt to avoid or time all market fluctuations often will sacrifice long-term growth opportunities. So while equities may feel uncomfortable during periods of uncertainty, they continue to be one of the most effective tools for building long-term wealth. Looking now at the performance of global equities from a regional perspective, the chart on the top shows the 3-month and 1-year returns of the major developed market regions against the MSCI World Index. And the chart on the bottom shows the 3-month and 1-year returns of the major EM regions against the MSCI EM index. And all returns here are shown in US dollar terms. So starting with developed markets, US equities posted their strongest run in years over the quarter. Falling oil prices, resilient economic data, continued strength in semiconductors drove this advance, though a handful of mega-cap names, including Alphabet, Nvidia, Amazon, Broadcom, and Apple, accounted for more than half of the S&P's return. The quarter's standout event was SpaceX's IPO in June, the largest on record, and an initial rally took its valuation with a whisker of $3 trillion in its first week. European markets also posted their strongest quarter since 2020, but marginally underperformed the DEM index. The weakening oil price helped to ease concerns around inflation, a key driver of sentiment given the continent's exposure to the energy crisis. The ECB also delivered its first rate hike since 2023, with a 25 basis point increase in June that took its deposit rate up to 2.25%. President Lagarde noted how the inflation shock was becoming broader in nature. Then the UK equity market had a positive quarter, but materially underperformed the rest of the developed market world, with a return of just 4%. And that was largely due to that market's high weighting towards oil companies, which came under pressure after the US and Iran agreed to open the Strait of Hormuz. On the political front, there was some significant unrest following poor election results earlier in May, which triggered the resignation of Prime Minister Starmer and, by extension, speculation about the direction any future administration could take. Japan was particularly impressive. For many years, Japan was considered a relatively stagnant market. Recently, though, reforms aimed at improving corporate governance, improving shareholder returns, and enhancing capital efficiency have attracted investors back to the market. And as a result, Japan has been the best performing major DM over the last year, with a return of close to 30% in dollar terms. Moving to emerging markets, it was a quarter of historic proportions, with the MSCI EM index advancing 24%, its best quarter since 2009, which is almost 20 years ago. And the quarter unfolded in two distinct phases. Firstly, a powerful and concentrated rally in April and May, as the AI hardware investment cycle drove Asian semiconductor champions to record highs, followed by a turbulent June in which two sharp bouts of AI-driven volatility tested investor conviction without breaking the structural narrative. And the regional dynamic was noteworthy in its concentration. South Korea and Taiwan anchored the asset class. Samsung Electronics and SK Hynix both crossed the $1 trillion market cap mark in May, reinforced by large-scale government backing for South Korea's semiconductor ambitions. While Taiwan's market delivered outsized gains with TSMC, the central transmission mechanism for global AI demand. And together, these two markets now account for more than half of the MSCI EM index, a concentration that drove exceptional returns in the upswing, but also drove negative returns in the downswing when disappointing guidance from US chipmaker Broadcom triggered outsized intramonth swings. This was widely interpreted as positioning-driven unwinds after a near doubling of some Asian markets this year, rather than evidence of deteriorating fundamentals. Elsewhere, performance reflected the divergent macro impact of the AI cycle and the energy shock. Chinese equities delivered negative dollar returns over the quarter as geopolitics, global tech volatility, and also offshore earnings pressure each took turns setting the tone. India underperformed through much of the quarter and year as its sensitivity to energy import costs left it exposed during the months of elevated oil prices, before recovering modestly in June as crude pulled back towards pre-conflict levels. Then in Latin America, net oil exporters outperformed in April, but gave back some of those gains as the commodity tailwind faded and a firmer US dollar weighed on regional currencies. And a key lesson from this slide is that global diversification remains extremely important. Even within a single asset class like equities, outcomes can vary dramatically between countries and regions. A diversified global portfolio helps investors participate in opportunities regardless of where the leadership emerges. One of the most fascinating aspects of the current market cycle is the concentration of performance among certain sectors. The clear standout has been the information technology sector, with a return of close to 40% in the quarter and more than 50% over the year. Technology companies continue to benefit from strong earnings growth, significant AI spending, and robust demand for computing power and digital infrastructure. Many of the largest contributors to global market returns over the last year have come from this sector. Industrials also perform well. This reflects growing investment in infrastructure, manufacturing reshoring, automation, and global supply chains. Financial companies produce solid returns as well, supported by healthy credit conditions and resilient economic activity. But the laggards over the short term was the energy sector and materials, with returns of minus 13% and 0% respectively. Energy markets experienced weaker commodity price trends during the quarter, leading to much more subdued performance. But despite the poor quarter, energy and materials were still two of the best performing sectors over the full year. While tech leadership has been remarkable, investors should remember that market leadership changes over time. The strongest performing sector today may not necessarily be the strongest performing sector 5 years from now. And that's why diversification across sectors also remains a prudent strategy. Rather than trying to predict the next winner, diversified investors can benefit regardless of where the opportunities emerge. This slide takes analysis one step deeper. It examines investment styles or factors. Momentum was the clear winner over both the quarter and the year. Momentum investing simply refers to owning assets that are already demonstrating strong price performance. During the last year, market leadership became increasingly concentrated among these high-performing companies, particularly those benefiting from AI and tech innovation, and as a result, momentum strategies significantly outperformed. The remaining styles or factors all delivered strong positive returns over the quarter and year, with growth being the second most dominant style and value being the most poorly rewarded style. Again, for investors, this reinforces an important principle. No investor can consistently predict which style will dominate next. Momentum's currently driving markets, but there will certainly be periods where value or quality will be the dominant style. So having exposure to multiple factors and investment styles creates a much more resilient portfolio and reduces dependence on any single market outcome. Looking now at currency performance, the table here shows the performance of key DM and EM currencies versus the rand over various trailing periods to the end of June. If the number is green, it means that currency strengthened against the rand, and red means that currency weakened against the rand. And as can be seen, most major currencies have been weakening against the rand over the short term. In other words, the rand has been very strong, particularly over 3 months, 6 months, and 1 year. And this is being driven by a weaker dollar globally, strong precious metals prices, improved investor confidence in South Africa, relatively attractive South African interest rates, strong foreign demand for SA bonds, and improved global risk appetite. The rand ended the quarter at around 16 rand 38 per dollar, and that compares to a rate of around 18 rand per dollar 1 year ago, about an 8% appreciation in the rand. This had an impact on offshore investments. And even when offshore assets generated strong foreign currency returns, some of those gains were reduced when converted back into rand. This is often a source of frustration for investors. While the rand has surprised on the upside this year, The same factors that have supported the rand can reverse quickly, which is why offshore diversification also remains a critical component of long-term investment portfolios. Turning now to South Africa, South African markets navigated a volatile second quarter, with the Middle East conflict serving as the dominant driver across asset class. The shock was transmitted primarily through commodity prices, energy prices, and bond yields. So with respect to equities, although financial and industrial stocks were quite resilient in the quarter, resources retreated significantly, with a return of close to minus 20%. And this pulled the entire market down, resulting in a negative quarterly return of minus 2.5%. The underperformance of SA equities over the last couple of quarters has resulted in SA equities now being behind both SA property and SA bonds over the full year. In terms of monetary policy developments over the quarter, the SARB raised the repo rate by 25 basis points to 7% at its May meeting. That decision was driven primarily by headline CPI moving toward the upper end of the 2 to 4% target, and concerns over second-round inflation effects stemming from the energy shock. Domestic bonds sold off quite sharply mid-quarter in response to rising inflation expectations and the geopolitical uncertainty, before recovering strongly in June as ceasefire negotiations progressed, leaving the all bond index up an impressive 8% for the quarter. The macro backdrop further provided support. GDP growth in the first quarter came in ahead of expectations, and South Africa also received sovereign credit rating upgrades from both Moody's and Fitch during the quarter. On a one-year view, the all bond index was up an incredible 21.5% over the full year. Property also generated very strong returns. After several challenging years, investors have become much more constructive on the sector. Improved balance sheets, attractive dividend yields, and less concerns over high bond yields have helped listed property recover quite meaningfully. Listed property was the best performing South African asset class over the quarter and is now also the best performer over 1 year, with a return of close to 30%. Lastly, cash continued to play its traditional role, providing stability as well as positive returns. Over the 1 year period, cash is ahead of SA inflation by more than 2%, which is historically above average. Drilling down to the performance of the local equity market from a sector perspective, the chart on this slide shows resources in red, financials in light blue, and industrials in dark green. With respect to resources over the last 6 months, large diversified mining companies like Anglo's and BHP have generally outperformed the single commodity miners. Strong gold and platinum group metal prices delivered much of last year's returns. Gold posted double-digit gains for each of the past 3 years, more than doubling in price, as central banks, asset managers, as well as retail investors have all been piling into the trade. But that rally ran out of steam in late January this year, shortly after the gold price hit an all-time high near $5,600 an ounce. The stronger dollar, increased likelihood of interest rate hikes, and profit-taking amid all the war uncertainty made gold less attractive relative to yield-bearing assets. Within industrials, shares such as Richemont, AB InBev, and MTN produced good returns. However, this was mostly negated by disappointing performance from Prosus and Naspers, whose share prices have fallen roughly 25% year to date. These two tech shares are still massively reliant on the performance of Tencent, which has been underperforming. In addition, their aggressive reinvestment plans in its Brazilian food delivery unit, iFood, and the ongoing sale of non-core assets like Delivery Hero affected investment sentiment. Then lastly, within financials, banking shares such as Discovery, Standard Bank, Capitec, and FirstRand have all performed well this year, as investors have become more optimistic about the outlook for the South African economy. And the banks themselves continue to produce resilient earnings and deliver attractive dividend yields. This slide provides a useful perspective by comparing South African asset classes with their global counterparts, all in rand terms, over the quarter. Local cash, bonds and property all handsomely outperform their global counterparts. However, global equities, both EM and DM, significantly outperform local equities in rand terms, shielding the performance of balanced funds in the quarter and proving the value of offshore diversification. Lastly, we show here the same chart, but for the 1-year period till the end of June. The first point to mention is that growth assets have continued to lead performance. Equities, both locally and globally, have remained the primary drivers of wealth creation, with local property also being a significant contributor. The second point to make is that diversification has been rewarded. Investors who maintained exposure to multiple asset classes, including property and bonds, benefited from several sources of return rather than relying solely on equity markets. And then the third theme is that opportunities exist both within South Africa and globally. The strongest portfolios were generally those that combined exposure to both local and global opportunities and participated in these global growth trends. And finally, this slide enforces or reinforces an important investment principle. Long-term success is not about predicting which market will perform best in any given quarter or year. It's all about building diversified portfolios that can participate in opportunities wherever they arise. Looking back over the period, investors have been rewarded for remaining invested, staying diversified, and focusing on long-term objectives rather than short-term market headlines. And that remains our key message today. Markets will continue to fluctuate, but disciplined investors who maintain diversified exposure across asset classes and geographies are generally best positioned to achieve their long-term financial goals. And lastly, a brief primer on the potentially severe impact of high inflation. This graphic is from Visualist Capitalist and Net Group Investments. It shows how the value of $100 at the beginning of the year is projected to diminish by the end of the year for the countries that are currently running the highest inflation rates in the world. Venezuela continues to face the world's highest inflation rate. If you had $100 at the start of the year, it's projected to be worth only $31 by the end of the year, a 70% decline in the amount of goods or services you can purchase. Iran has also battled high inflation for years, but the recent conflict has pushed prices even higher. $100 at the start of the year is projected to be worth just $67 by the end of the year. As fears of further disruption spread, many households rushed to stock up on essentials, triggering panic buying across the country. The point here is that inflation is more than a rise in prices. It is a silent thief of wealth. In order to merely preserve wealth, yet alone grow your wealth, your investment returns need to at least keep up with inflation. True wealth is only built when your investment returns outpace the rate of inflation by a meaningful margin. And that wraps up our review for the second quarter for financial markets. Thanks for listening in. We truly value your time and attention and support. Keep well.
Thank you, Cole. Please welcome Rupert Giesing, Portfolio Manager at Equilibrium, with an update on the MFP multi-managed portfolios. Rupert, the floor is yours.
Thank you, Therese, and thank you, Cole, for the comprehensive market overview. Now, let's take a closer look at the performance of our focus range of solutions and how it has played out during the second quarter. Taking into account the market volatility that we've seen since the beginning of the year that continued into the second quarter, as just discussed, it has proven more challenging relative to our positioning. However, Overall, it was a strong second quarter for the multi-asset Focus 3, 5 and 7 solutions, with longer-term competitiveness over the respective horizons of the solutions still in good shape. It's a testament to the robust construction of these solutions, benefiting from diversification between the various asset classes linked to their respective time horizons. For the quarter, MFP Focus 3 was up by 4.9%, while the Focus 5 and Focus 7 portfolios were up by 4.7% and 4.4% respectively. The Momentum Focus Fund of Funds delivered similar healthy returns of 4.7% for Focus 3, while Focus 5 and 7 were both up by 3.9%. Over 1 year, the Fund of Funds as well as the model portfolios have continued to deliver solid returns, ahead of both their benchmarks and peer groups. The model portfolios were up by 13, 14.8 and 14.6% respectively for Focus 3, 5 and 7, and the Fund of Funds by 15.5, 15.8 and 15.9%. The Fund of Funds are also ahead of their benchmarks and peer groups over their respective time horizons of 3, 5 and 7 years. MFP Focus 3, 5 and 7 model portfolios continue to deliver on their objectives since their launch 63 months ago, with all three portfolios ahead of both their benchmarks and peer groups over the period, as well as the intended time horizons of 3 and 5 years for Focus 3 and Focus 5. Then, on to our newer solutions, the unconstrained equity model portfolio that is now just under a year old. It delivered a positive return of 4.2% for the quarter, ahead of its combined local and global equity benchmark return of 3.8%. It is worth noting that we have an overweight position in local equity in the portfolio, which would have detracted over the quarter. With the asset class coming under pressure due to the sell-off in the resources sector that dragged it down overall, despite positive returns for both the financials and industrial sector. Within our global equity exposure, our overweight position in emerging markets continues to contribute to performance, together with the rand weakening by 4.2% during the quarter that further supported returns. Being an equity-only solution, one can expect significantly more volatility in the portfolio over the short term, and, as a reminder, the intended investment horizon is a minimum of 7 years. The more recently launched MFP Focus 7 TFSA or tax-free savings portfolio that is now 8 months old delivered a positive return of 4.8% for the quarter. With tactical positioning similar to the Focus 7 model portfolio, it outperformed both the CPI plus 5% benchmark as well as the peer group over the quarter. Since launch, it has also managed to outperform the peer group while slightly lagging the benchmark. We want to stress again that it is still very early in the life of the portfolio, which also has a minimum recommended investment horizon of 7 years. Then, onto the also recently launched hedge funds. These portfolios delivered marginally negative returns for the quarter, with the stable and growth portfolios down 0.2% and 0.6% respectively. Once again, it is still very early days for these solutions, with minimum recommended time horizons of 3 and 7 years respectively. They can play an important role as a diversifier over the long term in client portfolios. Looking at the performance heat map and using the Focus Fund of Funds as a proxy, we can see that relative performance held up very well, with all three delivering top or second quartile results. It is also a powerful illustration of how quickly things can change. Considering our positioning is largely the same as last quarter, where our more aggressively positioned tilts worked against us, which is in stark contrast to this quarter, where they managed to capture upside returns very effectively. It is a reminder of why it is important to follow a disciplined investment approach with the long-term objectives in mind when navigating short-term volatility. The delivery over the time horizons of the solutions of 3, 5 and 7 years are also in the first and second quartile. Now, let's unpack how our investment decisions played out in more detail. Our robust portfolio construction, expressed through the strategic asset allocation process, meaning how much we allocate to the respective asset classes for each of the constructs, all delivered peer group beating returns over the past year. Using the focus model portfolios as a proxy, our tactical asset allocation or TAA decisions, meaning how our short-term decision making and asset class tools complemented the strategic asset allocation, contributed positively to performance over the past 12 months. In all three of the portfolios, it added 0.43%, 0.45% and 0.74% to focus 3, 5 and 7 respectively over the past year. Manager selection unfortunately detracted overall 1.98, 1.48 and 2.3% from focus 3, 5 and 7. We will unpack this in more detail shortly. Now, observing the TAA decision in more detail. Our underweight position in local cash contributed positively to performance. This in turn was complemented by using the allocation to fund overweight positions in local bonds and equity, as we continue to feel optimistic about the prospects for these asset classes. Even if the recent pullback by the resources sector would have detracted from returns in the past quarter. Underweight positions in both global bonds and cash further contributed positively. As you will recall from our market review, the strengthening rand detracted from the performance of global asset classes over the past year, meaning both global cash and bonds delivered negative returns in rand terms. Our underweight position cushioned the impact of negative returns from these asset classes. The decision to increase exposure to emerging markets in global equity further contributed, though it was not quite enough to offset volatility in global equity, with developed markets detracting from overall performance over the past 12 months. This means that global equity as a whole detracted marginally. Now, let's unpack the manager selection effects in more detail. The following slide shows the positive and negative contribution to performance of the top 4 and bottom 4 funds used in the construction of the Focus multi-asset solutions. Contributing positively to performance were the Curate Momentum Enhanced Yield Fund, the Momentum Flexible Fixed Interest Fund, which, as a reminder, consists of 3 fixed income mandates managed by Prescient, Coronation and 91 respectively. Then also the Curate Momentum Global Emerging Markets Equity Fund, as well as the Curate Momentum Flexible Property Fund. The top detractors from performance were the Visio BCI Unconstrained Fixed Interest Fund in the Focus 3 model portfolio specifically. As this is the only one of the portfolios where it is used, it is important to note that the fund itself delivered strong performance, but where it is applied in the Focus 3 construct relative to the All Bond Index, it detracted from the performance of the bond building block. You might recall that during last quarter, we did a realignment of the cash and fixed income exposure in the Focus 3 model portfolio and fund of funds, and as a result, reduced exposure to the Visio fund in the model portfolio. This change should significantly reduce the tracking error in the fixed income building block in the portfolio in future. The Curate Momentum Global Sustainable Equity Feeder Fund also detracted. As a reminder, for internal benchmarking purposes, we use the MSCI All Countries World Index, which includes emerging markets. Due to the strong recent performance of emerging markets, the Sustainable Equity Feeder Fund underperformed relative to this benchmark. That includes emerging markets, however, compared to the MSCI World Index, which includes only developed markets, performance of the fund has been satisfactory. Only 0.5% behind the benchmark, net of fees over the past year. The fund had a strong quarter too, outperforming developed market equities by almost 2%. However, underexposure to US energy stocks during the first quarter, subsequent to the start of the war in Iran, did detract from relative performance. In the local equity building block, Fairtree had the most significant detraction, with an overweight position in PGMs contributing the most to underperformance relative to the capped all-share index. And then lastly, the Coronation Global Emerging Markets Fund that had a difficult year with various stock selections detracting from performance. However, the fund has started to show a strong recovery recently, contributing in terms of active management and providing diversification away from increasingly concentrated holdings in artificial intelligence and semiconductor themes. as emerging markets are also becoming increasingly top-heavy, rather than broadly diversified across the developing world. Now, let's move on to our portfolio positioning and outlook. Global equity markets have demonstrated notable resilience in 2026 despite geopolitical disruptions such as the escalation of the Iran conflict. The initial sell-off following the conflict was rapidly reversed, largely due to exceptionally strong United States earnings growth and broad-based upward revisions to profit expectations. In contrast, global bond markets face structural headwinds. Rising inflation, elevated fiscal deficits, high issuance levels, and significant US refinancing risks, with a large portion of debt maturing soon, are contributing to persistently high bond yields. These dynamics remain fundamentally negative for bond returns and undermine their traditional defensive role. Despite a supportive fundamental environment for global equities, there are some risks. Valuations, particularly in the US, remains elevated, and the sustainability of returns is increasingly dependent on interest rate dynamics. With bond yields rising, the discount rate applied to future cash flows is increasing, placing pressure on equity valuations. Overall, the global asset allocation case remains firmly in favor of equities over bonds. However, increasing sensitivity to interest rate movements in developed markets suggests that equity returns may become more volatile and dependent on macroeconomic conditions going forward. Within global equities and on a relative basis, our preference for emerging markets over developed markets remain, though we are cautious around allocation. As the growing AI-related concentration risk in emerging market indices become more prevalent. But ultimately, it's about earnings growth potential and valuations. Consensus expectations shows EM companies delivering meaningfully stronger earnings growth than developed markets in 2026 and 2027. Importantly, this isn't just about excitement or sentiment. It's supported by underlying business fundamentals. Faster earnings growth provides a solid foundation for future market returns. We are seeing stronger profit growth from emerging market companies than many of their developed market peers, which supports maintaining a higher allocation relative to developed market equities. Emerging markets is also an attractive way of accessing the AI theme. The current reality is that several world-class AI and semiconductor companies, including TSMC, SK Hynix, and Samsung, are based in emerging markets. What makes this particularly attractive is that EM AI-related companies appear significantly cheaper relative to the expected growth compared to their developed market counterparts. From a valuations perspective, emerging markets also remain attractively valued, even after strong recent performance. Often, the concern after a strong rally is whether investors have missed the opportunity. This chart suggests that is not the case. Emerging markets continue to trade at a meaningful discount to developed market equities relative to history. In fact, today's discount is larger than the long-term average. We therefore have a combination of stronger earnings growth and cheaper valuations, which is a compelling investment proposition. Overall, we believe investors are still being compensated for owning emerging markets despite the strong returns already delivered. SA asset classes continue to stand out as offering undeniable value, with valuations remaining depressed relative to both history as well as EM peers. This creates a favorable risk and reward asymmetry for investors. SA equities are one of the most compelling opportunities in global markets in a post-Iran war environment, in our view. A combination of attractive valuations, recovering fundamentals, and structural positioning supports a strong investment case going forward. Valuations are particularly noteworthy. If one considers overall valuation levels of emerging markets compared to developed markets, as just discussed, SA equities trade at a significant discount to both EMs and even more so DMs, with forward multiples well below historical averages. This discount is partly due to persistent under-ownership by global investors, reflecting historical concerns about poor local growth and policy uncertainty. However, this positioning creates the potential for significant inflows should sentiment improve. The underlying fundamentals remain supportive. SA earnings growth expectations are strong, driven largely by the resources sector, although there is acknowledged downside risk from commodity price volatility. However, even under conservative profit assumptions, valuation metrics remain attractive, with the SA equity market forward PE 1 standard deviation below its long-term average. SA nominal government bonds continue to offer attractive real yields, making them a standout fixed income opportunity globally. Real yields remain elevated relative to both historical norms and international peers, reflecting the higher risk premia still attached to SA bonds. Fundamental fair value analysis suggests that the potential for capital appreciation from SA nominal bonds. As local inflation first stabilizes and then retraces after the Iran war, policy rates should decline again. Bond yields are hence expected to fall, resulting in capital gains supplementing income returns from the asset class. Foreign investor behavior provides additional support for SA bonds. After briefly exiting during the early stages of the Iran conflict, foreign investors have returned to the SA bond market as buyers, attracted by the high yields and improving fiscal credibility. This consistent foreign demand should underpin bond valuations. SA-listed property companies continues to report strong results, with improving distribution and dividends reflecting firmer operational performance and lower funding costs. Operational fundamentals have improved significantly, supported by lower vacancies, positive base rental growth, and broadly stable cost-to-income ratios. The operating recovery is further supported by constrained supply. While retail property development has been muted, meaningful retail store rollouts confirm demand for retail space from dominant grocers. Importantly, the sector should benefit from our expectations of declining domestic bond yields. As yields fall, property valuations are likely to improve, creating scope for capital appreciation in addition to income returns. Overall, SA-listed property offers a combination of improving fundamentals, attractive valuations, and supportive macro conditions. Bringing it all together, our overarching asset allocation position remains unchanged. A clear preference for SA equities and nominal bonds, complemented by selective exposure to emerging market equities and diversification through listed property. We remain cautious on global fixed income due to higher developed market bond issuance and rising inflation. SA cash, while offering positive real returns, remain less attractive compared to other asset classes. And in closing, let's take a look at how we implement our views in the portfolios. Over the short term, global financial market resilience will continue to be tested by a complex and dynamic combination of sticky inflation, diverging central bank policies, a volatile geopolitical landscape, and questions around massive artificial intelligence capital expenditure. We will continue to navigate this unpredictable environment with our positioning largely unchanged. In line with our views on local asset classes, we will maintain our tilts favouring SA equities and bonds, where we fund the allocations from cash. Taking into account the positive outlook for SA bonds, we will marginally add to our overweight position, continuing to source the allocation from local cash. Globally, our tilts remain in favour of emerging markets that we will continue to fund from bonds. This also allows us to stay currency neutral while maintaining our neutral position in developed market equities. Thank you for your time, and we'll catch you at the next one. Back to you, Therese.
Thank you, Rupert. Now, staying with portfolio positioning, our next session will provide insights into the global portfolio performance and also the thinking behind the current positioning decisions. Please welcome Jade Koish, a senior analyst and an ESG specialist from our MGIM London office, and she will take us through the global portfolio performance and positioning. Jade, over to you.
Thank you and welcome everyone. Let's get started. So coming into the second quarter, investors were feeling particularly bullish about equities, and in particular, bullish about equities relative to bonds. This risk-on sentiment was very much driven by investors feeling jubilant that tensions were de-escalating in the Middle East. And this optimism around equities, in fact, peaked at levels beyond the levels that we saw during the tech bubble, which you can see on the left-hand side of the chart there. So a lot of optimism around equities, which really drove that risk-on sentiment. And this was really reflected in asset class returns. So you can see here that equities posted very strong gains during the quarter. That's both developed and emerging markets from those top two lines there. Emerging markets, in fact, did particularly well because of strong positive returns from Asian equities. A small number of AI-related stocks were up significantly, which I'll talk a little bit more about later. Now, bond performance was broadly flat over the quarter, particularly on the lower risk end of the scale. And that's because investors tend to shy away from the defensive areas of the market during the second quarter in favor of more risky areas of the market. And we saw particularly strong gains coming from semiconductor stocks. So this chart here shows the Philadelphia Semiconductor Index, so generally showing US semiconductor stocks. And you can see that performance goes up pretty much in a vertical line, so phenomenally strong performance. And this was driven by a lot of spending on AI infrastructure. This was driven by strong earnings growth during the quarter. And also, these things fueled a huge rise in popularity of these companies. Now, these very strong returns have also, in turn, pushed up valuations of these stocks. But again, we'll come on to that a little bit later. And this is just looking at the US, but in fact, this also affected other areas of the market as well. So you can see here, this is the Kospi Index. So this is Korean companies. And again, you have that almost vertical line showing very strong performance of the index during the second quarter. Now, the strong performance was actually driven by just two companies within the index, which at the time of recording represented about 50% of the Kospi Index. And that's SK Hynix and Samsung. So again, two semiconductor stocks that generated very strong positive performance over the quarter. So it's very obvious to see that certain areas of the technology sector have done phenomenally well. However, it has not just been about technology stocks or not just been about semiconductor stocks. You can see from this chart here that the mention of the words AI disruption in quarterly earnings calls have gone up significantly during the first half of this year. So compared to the second half of last year, companies are now talking about AI disruption by about 6 times more than previously. And it's not just technology companies that are talking about AI disruption, but this is across all sectors and all different companies are talking about AI disruption. So it's not just about technology. And you can see that here in this performance chart. So this just looks at the US, but it's very much the same message across the regions as well. But AI is very much touching many, if not all, areas of the market. The Magnificent Seven, so those mega cap technology companies, those hyperscalers, still generated positive performance during the second quarter, but it wasn't the winning area during Q2. And in fact, the strongest performing area of the US market was small caps. And then we also have strong performance coming from value stocks as well as growth stocks. In the growth bucket, it tends to be where those technology companies sit, whereas we saw strong performance coming from banks, for example, and that's because of AI-driven capital market spend. So an example of where AI is driving returns in different areas of the market. Also, something important to point out in this on this graph is that the equally weighted S&P 500 index outperformed the S&P 500 index. Now, within the S&P 500 index, it has a much higher weight allocated to the Magnificent Seven stocks because of the significant size of those companies. But with the equally weighted S&P 500, it's on the tin, they're equally weighted. that index did do better in the second quarter, and that shows that returns of those other 497 stocks have been better overall than just the Magnificent Seven. So it hasn't just all been about mega cap technology. Again, this demonstrates that performance has been, touching other areas of the market. Now, with strong performance, of course, you're going to get an uptick in valuations as well. You can see here from this chart that, in fact, outside of the US, most regions don't actually look that expensive relative to the last 25 years of their own history. But even in the US, you can see that median valuation. So that's the straight line, the straight horizontal line in the left side of the chart. The median valuation is still sitting within the lower half of the range of valuations for the US. So this really outlines that there are still pockets of value within the US, even though on a holistic basis it does look expensive, but it's being skewed by some of those mega cap companies within the market. And then when we look at other regions, generally, again, this points out the fact that the markets aren't looking overly expensive, and there are pockets of value. What this is generally saying to us is that active management at a time like this is incredibly important. Careful stock selection is really key, because you don't want to be invested across the full market in these very expensive stocks just in case things go wrong. And I think this chart here demonstrates that point very well. So this here shows us that, you don't want to be holding the wrong stocks when the bubble bursts. I'm not saying that we're in a bubble at the moment, but just that in 2001, that was the tech bubble, and it did in fact burst. And you can see this is the share price of Intel, which in 2001, when the bubble burst, the valuation fell by 75%. And it has in fact taken Intel 20 years to make back that performance and get back to that level, that share price level that it held back in 2000. So it can take decades to recover your losses after a valuation surge. So it's very important that you're invested in the right areas of the market, that you're not overly exposed to areas that could be potentially exposed to a bubble bursting. And again, that's why we think it's important to be allocated to active managers who are managing this risk well. Now, we're also seeing risk elsewhere. So, for example, this chart here shows us that we are seeing the return of inflation. This is coming predominantly from the closure of the Strait of Hormuz, where transport of oil and other goods has been limited or stopped completely for months. And that has just meant that the price of goods have gone up significantly. This affects both the consumer, it affects as well as companies as well. That's because, transporting goods becomes more expensive, as well as individual goods that, are not able to be distributed globally. For example, something we talked about last quarter was the fact that 20% of the global fertilizer comes through the Strait of Hormuz. Now, if that isn't being distributed globally, then the fertilizer that is available becomes more expensive because of that shortage. And that then has a knock-on effect to things like food prices, for example. So we are seeing this risk from rising inflation coming back as well. And with rising inflation comes the expectation that we will likely see an increase in interest rates as well, which you can see interest rate expectations on this chart are trending upwards again. And this means that borrowing costs will rise for both companies and also for individuals as well. We've seen a significant amount of borrowing from companies who are investing in artificial intelligence. They obviously have to pay that back, and it's going to be at a much higher rate than they anticipated when they first took out that borrowing, and that will have a huge effect on them. As well as the individual. So, something a little bit closer to home. In the UK, 25% of mortgages are up for renewal this year, which means, this isn't people buying a house. They can't decide not to do it. They have to renew their mortgage. And so they're going to be paying a higher rate than they expected to be paying. And that obviously has a knock-on effect to the amount of money that individuals have. So this has big implications for, again, both corporates and the individual. And of course, that has a knock-on effect on markets as well. So we're expecting a lot more volatility coming through in markets. However, so far, markets have proved to be very resilient to negative news and events. So although we are expecting volatility, it's difficult to predict what the long-term and the lasting impact is going to be, or, if and when we're going to feel that impact coming through. And onto the positioning and performance of the portfolios. Firstly, a recap of how the portfolios are positioned. So firstly, we have the cautious fund on the left-hand side there, which has invested about 30% in equities and 70% in bonds and other diversifying asset classes. Then in the middle, we have the managed portfolio, which has invested about 60% in equities and 40% in bonds and diversifying asset classes. And we have the growth portfolio on the right-hand side, which is 90% equities and 10% in bonds and other diversifying asset classes. Looking at longer term performance on this chart, you can see that both the growth and the managed portfolios are outperforming their cash plus targets. So very happy with performance there. The cautious portfolio is slightly lagging its target. This is because performance in 2022 was particularly difficult, both on the equities and on the fixed income side. But the bond performance had a particularly negative impact on the cautious portfolio, where that allocation is higher. And we have recouped some of those losses. We have closed the gap a little bit, but we are still slightly lagging that target at the bottom there. Moving on to sort of slightly shorter term performance. On the side, you can see the black boxes outline the holding periods for the three different portfolios. And the cautious and growth portfolio are both ahead of their global cash targets. Managed is ahead of the peer group, but is lagging the cash target over its 5-year holding period. And again, the reason for that is that 2022 performance. So for the managed portfolio, longer term and shorter term performance, the portfolio is outperforming its target. However, when we're just looking at that 5-year number, that 2022 performance is still feeding into that number and it's having quite a significant impact. But overall, we're happy with the longer term performance of the portfolio. And that number will improve as that 2022 number slowly works its way out of that 5-year number. Then let's focus on Q2 performance. Generally, it was a very strong performance across all of the portfolios. So very happy that the portfolios have all outperformed their cash plus targets. Performance is better for the growth portfolio because it has a higher allocation to risky assets. Whereas although performance in the cautious portfolio has also been very strong, it's not as strong because it has a higher allocation to the more defensive areas of the market, but all in line with expectations there. So this here just demonstrates the portfolio's performance relative to a blended benchmark. So this is the managed portfolio. As a demonstration, the message is similar across the range, but this is the managed portfolio relative to a 60% equity, 40% bond blended benchmark. And you can see here that the portfolio slightly outperformed that benchmark. The biggest contributor was in fact manager selection. In particular, those equity managers have done very well, which I'll come on to speak about. And then also the higher risk bonds within the portfolio have had a positive impact on performance. Asset allocation, unfortunately, has slightly detracted over the quarter. And the reason for that is because the portfolios are slightly underweight equity and they're slightly overweight bonds. And with investors' preference for riskier assets, this means that positioning had a little drag on performance. And then this message is the same for cautious and the growth portfolios as well. So looking at some of the performance drivers in terms of what did and didn't work. So because of the tensions declining in the Middle East, and that really driving a risk on sentiment, you can see here that almost everything in the green column, so what helped is they're all risk on assets, whereas everything that hurt, that was all defensive assets. So you can see here that it was higher yielding bonds, so riskier bonds that performed well over the quarter. So the likes of global evolution, emerging market debt, and then also our high yield credit portfolios did well as well. On the equity side, that's where we saw the biggest impact. So I've put the numbers on the slide which we don't normally do, but I just thought they're such big numbers. It's important to highlight, how stark these figures are. But you can see here that, Granahan, which is a high growth, small and mid cap manager, has done phenomenally well. We have Jennison, which is a growth manager. They've done very well as well. But then interestingly, we also have Lyrical Global, which is a value manager who have also done very well and contributed to performance over the quarter. Then on the other side of that, we have the Robeco Conservative portfolio, and then the Evenlode Global Equity portfolio, which is a quality manager, which has underperformed. And the reason for that is because that continuation of the expectation that quality is going to be a negative beneficiary of the AI theme. And so the style continues to underperform. But overall, Evenlode continue to stick to their knitting. And when and if things turn around, quality is poised to do well because those valuations are looking very beaten up now. Within emerging markets, the managers across the board did pretty well, but Fidelity was very much a standout performer. The reason for that is strong stock selection. They have an overweight to technology and are tilted towards growth. Both of those things benefited the portfolio, and they were up significantly over the quarter. And then within our real assets portion of the portfolio, the Momentum Real Assets Growth and Income Fund did very well, and that's particularly because of the property and infrastructure holdings within that portfolio. So overall, a really strong quarter for the three portfolios. So on to portfolio activity and current positioning. So this slide here just demonstrates our views and how we're thinking about asset classes at the moment, and it broadly represents how the portfolios are positioned today. So we have a slight underweight to equities, and that demonstrates our view on equities overall, that we think that overall the market is overvalued, particularly within the US. Although, as I mentioned earlier, we do see pockets of value in across different regions, but we are slightly underweight. We are overweight more risky areas of the bond market, so emerging market debt and the high yield as well. We're slightly underweight government bonds because we see more value in credit today in general. We're overweight real assets, and this is because we see positive fundamentals and also attractive valuations in this space. In terms of what changes that we made over the quarter, so following very strong performance of equities, we decided to slightly reduce the allocation across the portfolios to equities. So we reduced our allocation to the Global Equity Fund and also added an allocation to the Sustainable Equity Fund. It's also global equities, but it is a semi-active, semi-passive portfolio. So it has a lower tracking error, lower active risk. And so it just took a little bit of risk off the table there. And it also diversifies that global equity fund exposure within the portfolios. I added a small allocation to a NASDAQ ETF. And that just brought up our exposure to the US slightly. So I realise it's a bit contradictory in terms of us speaking about how expensive the US market is at the moment. So I would highlight that we still do remain pretty underweight the US, but this just meant that it slightly closed that underweight a little bit, just to make sure that when the US is outperforming, our performance is not just totally taken out by that. So important to make these risk-aware decisions in the portfolios. Within emerging market equities, we switched out of the passive BlackRock emerging market equities portfolio and switched into the Momentum Global Emerging Market Equities Fund. And the reason for this is that the Momentum Emerging Market Equity Fund offers superior risk-return metrics. Again, it's that semi-active approach rather than being pure passive like the BlackRock portfolio is. And it's offered at a very similar fee. Makes sense to switch into something where we expect to get higher returns at a similar fee. Within the fixed income portion of the portfolio, we in fact increased our exposure to the higher carrying fixed income sectors, such as emerging market debt and high yield credits. So in the ways of 24 and Candriam, for example. So these portfolios offer very attractive yields, and high yield has a lower sensitivity to interest rates than investment grade credit, for example. So we think that move makes sense. We also introduced some global convertible bonds into the portfolio at a small weight. And the reason for this is because they do offer equity-like participation. So although we brought down our equity weights, we did add an allocation to global convertible bonds. So similar to equity returns. However, they offer a bit more downside protection through that sort of bond plus embedded call option positioning. And then also something I spoke about in the last quarter is that we added a small position to a defense ETF in very early April, so very early in the quarter. This is a long-term theme where we see positive upside, but I won't go into too much detail because I talked about that last time. But overall, those are the changes that we made in the portfolios. And that's all from me. So thank you very much for listening.
Thank you, Jade. Our final investment update for the morning comes from Curate Investments. Please welcome Nkosana Nzima, Fund Specialist. Nkosana, please go ahead.
Thank you, Therese. Good day, everyone, and thank you for your time. One of the biggest misconceptions in investing is that successful investors are able to predict what happens next. We often assume great outcomes come from forecasting interest rates, geopolitical events, or market moves. In reality, long-term investment success has far less to do with predictions and far more to do with the process. When we look across the Curate range, we see different managers, different asset classes, and different investment styles. Yet, the common thread is disciplined process. That process is what helps managers remain focused when markets become emotional, and it is what ultimately supports client outcomes. Today, I want to walk you through how the Curate range fits into the MFP Wealth Management Framework, and how each strategy contributes to achieving different client outcomes. The MFP framework starts with the reality that different investors need different outcomes. Some clients need liquidity, stability, and income. Other clients require mid-term capital growth. Others are investing for long-term wealth creation. That is why we structure portfolios using building blocks with clearly defined roles. Income solutions provide stability and diversification. Multi-asset and property solutions help drive mid-term growth. Local and global equity strategies provide long-term capital growth. The key is not trying to find one fund that does everything. The key is combining complementary strategies that work together through different market environments. Let's begin with income. The income allocation within the framework often receives the least attention when markets are strong. Yet, it is frequently the part of the portfolio that provides the greatest comfort when volatility rises. These solutions are designed to preserve capital, provide liquidity, and generate attractive risk-adjusted returns above cash, while maintaining stability. The Curate income range is built around 3 distinct outcomes. Enhanced yield is designed as a cash plus solution. Flexible income sits between traditional income and multi-asset income. Income Plus provides an additional diversifying source of return. What is important is that all 3 funds are managed by the Momentum Fixed Income team, a specialist team with a strong focus on downside protection and disciplined risk management. The Enhanced Yield Fund continues to demonstrate exactly why it occupies such an important place in a client's portfolio. During the quarter, the fund benefited from elevated short-term interest rates, high-quality fixed-rate opportunities, and bank-structured exposures. The manager remained disciplined and did not materially alter the portfolio simply because the market sentiment shifted. Instead, the focus remained on harvesting attractive yields while maintaining liquidity. That discipline continues to show up in the results. Since inception, the fund has delivered ahead of its STEFI Plus objective while maintaining the conservative profile investors expect from a cash plus strategy. For advisors, this remains an excellent solution for emergency reserves, short-term investments, and clients seeking stability without sacrificing return potential. The Flexible Income Fund provides an excellent example of why process matters. Earlier this year, volatility in government bonds created a significant opportunity set. Rather than reacting emotionally, the manager viewed the sell-off as a liquidity event rather than a deterioration of fundamentals. As yields moved higher, duration exposure was increased in selected opportunities. Those decisions required conviction because sentiment was extremely negative at the time. As yields subsequently retraced and bond markets recovered, the portfolio benefited significantly. Government bonds were the largest contributor to performance. Corporate credit and property exposure also added value. What I think is important is the behavioral lesson. The best opportunities rarely feel comfortable in real time. Often the highest future returns are available precisely when investors are most nervous. The Flexible Income Fund demonstrates how disciplined portfolio management can convert volatility into opportunity. Income Plus continues to focus on diversification. Throughout the period, the manager prioritized liquidity, maintained exposure to quality credit opportunities, and selectively allocated capital to opportunities where spreads became attractive. Importantly, the manager was able to take advantage of opportunities in offshore bonds where risk-adjusted returns look compelling. Again, there was no dramatic repositioning, just a consistent focus on valuation, diversification, and liquidity. This is one of the most powerful slides in the deck. The Income Plus Fund has delivered positive monthly returns in 118 out of the 120 months. That tells us a great deal about the consistency of the strategy. Just as importantly, the fund exhibits low correlation to traditional asset classes. Diversification is not about owning more investments. Diversification is about owning investments that behave differently. Income Plus continues to provide that differentiated return profile and remains a valuable diversifier within broader client portfolios. Let's now move into medium to long-term capital growth section of the framework. Here we begin to introduce more growth assets, but again, through specialist managers with clearly defined processes. One of Visio's greatest advantages is its ability to access opportunities that are often too small for much larger funds. When a manager runs hundreds of billions of rands, many opportunities simply cannot impact performance. Visio's size allows it to be far more nimble. During the quarter, the manager selectively added to opportunities such as Process and Pick and Pay, where valuations became increasingly attractive. The portfolio remains concentrated in high conviction ideas where management believes fundamental value significantly exceeds current pricing. This slide provides a window into how Visio thinks about investing. Whether we look at global champions, domestic leaders, or specialist opportunities, the common thread is disciplined fundamental analysis. The team looks for strong governance, experienced management teams, quality balance sheets, and sustainable cash generation. What stands out is that many of these opportunities are underappreciated by the broader market. The manager is not trying to predict short-term outcomes. The manager is trying to identify businesses where long-term value is significantly greater than current market expectations. Over the quarter, TSMC was one of the strongest contributors as continued AI-related demand supported semiconductor businesses. At the same time, gold-related positions detracted from returns. Importantly, however, the manager continues to view gold as a valuable hedge against geopolitical uncertainty, inflation risks, and fiscal concerns. The key takeaway is that the manager remains committed to the long-term investment thesis rather than reacting to short-term price movements. Moving to property. One of the most important messages from this slide is that property is no longer simply a South African listed property story. Globally, investors have access to more than 16 sectors across 9 regions: data centers, healthcare property, logistics, student accommodation, and senior housing, all provide access to specialist investment themes. This greatly expands the opportunity set available to investors. This is arguably one of the most compelling structural investment opportunities within the property allocation. The global population is aging. Demand for senior housing continues to grow strongly, while supply remains constrained. Construction activity remains well below historical peaks, and occupancy trends continue to improve. As a result, healthcare REITs continue to benefit from a powerful demographic tailwind. This is a long-term structural theme rather than a short-term market view. The benefit of diversification continues to show up in the performance. Both local and global property exposure contributed positively. Strong contributions came from holdings such as Growthpoint, Vukile, Redefine, and NEPI. By combining local and offshore property exposure, the fund can access multiple return drivers while reducing concentration risk. Moving to local equities. Laurium continues to focus on opportunities where valuations and fundamentals remain compelling. The manager increased exposure to selected South African opportunities, including FirstRand and Prosus, while maintaining exposures to areas such as gold and selected global businesses. FirstRand was one of the strongest contributors during the quarter and remains the manager's preferred banking exposure. Again, this highlights the benefit of active management and disciplined stock selection. The final section takes us into global equities. Global exposure remains a critical component of long-term portfolio construction. Not only does it provide access to different economies and sectors, but it also provides access to different investment styles and return drivers. The Robeco process provides one of the clearest examples of systematic investing. Rather than relying on predictions, the process evaluates hundreds of stocks based on factors such as value, quality, momentum, and analyst revisions. Every month, the process is rebalanced and consistently applied. The benefit is that emotional decision-making is removed from portfolio construction. The Sustainable Equity Fund continues to show how a disciplined process can derive outcomes over time. The portfolio has continued to outperform the benchmark and peers since inception. What is important is that this outperformance is not dependent on one stock or one theme. It is the result of a repeatable stock selection process that consistently seeks companies exhibiting attractive characteristics. We see a similar pattern within emerging markets. The same quantitative process continues to identify opportunities across emerging market economies. Despite the challenges often associated with emerging market investing, the fund has delivered strong relative performance and consistent outperformance since inception. The key lesson is that disciplined investment remains effective even in more volatile markets. As we conclude, I'd like to come back to a simple point. Across the Curate range, we have different asset classes, different managers, and different investment philosophies. But the common thread remains process. The managers have not been trying to predict every market outcome. Instead, they remained disciplined, valuation-focused, and committed to their investment philosophies. Ultimately, this is what the MFP framework is designed to achieve, not predicting the future, but combining a range of specialist building blocks that can help investors achieve better outcomes over the long term. Because ultimately, outcomes do matter.
Thank you to all our speakers and to each of you for joining us. Today's discussions reminded us that while markets will continue to evolve, clients will always need perspective, confidence, and trusted advice. We really appreciate your continued partnership, and I look forward to welcoming you to the next Outcome Matters session. Until then, keep focusing on what matters most, helping clients turn uncertainty into confidence and plans into outcomes. Have a wonderful day.